Well, while investors are showing a greater willingness to take on risk, our next guest is warning that the U.S. bull market is due for a pause. Joining us now, we want to bring in Chris Watling. He's Longview Economics global economist and chief market strategist. So, Chris, talk to us just about the fact that why you think the U.S. bull market is due for a pause.
I mean, well, multiple reasons, but primarily, I mean, the bull market in the States rarely goes more than 2.25 years without a big break. I mean, it doesn't have to be a bear market, but certainly a big break, a multi-month pullback. Maybe it's 10%, maybe it's a little bit more than that. And you can see that if you look at the history of the S&P 500 all the way back to the 1970s, it almost never goes longer than that without a meaningful crack. And you can see the signs of it. It looks tired. I mean, as we were just hearing, there's been rotation away from US equities. Other parts of the world are doing a lot better this year. And also it looks to us that not only is the bull market looking tired from a technical perspective, but I think the US economy is going to struggle in the first half of this year. The sort of enthusiasm about the US is really widespread and strong coming into this year. But actually, when I look at Trump's economic agenda and the way he's playing it and the order of that agenda, I think it's going to be negative for growth in the first sort of part of that agenda, perhaps first half of this year, maybe first 3 quarters, and then it gets much better for growth going on out. So I think there's a bit of a growth issue in the US relative to expectations. It's going to be softer. I mean, I emphasize the relative because, of course, growth, it will still be there. And then the bull market looks tired. It needs a break. And we're getting sector rotation globally that doesn't favor the US large caps. So it's kind of a mixture of technical factors and macro factors that are concerning us at this juncture.
Yeah, you mentioned some of the pressures that could be induced because of policy, but then on the backside of that, on the rebound, would it just be relief that perhaps the policy that's talked about, perhaps beginning as negotiation and then starts to get into actually how it plays out and perhaps backing off of some of the worst extents of that negotiation, that it's just relief that it's not as bad as it could have been, and then we start to get more clarity around how companies could operate in that macro?
Well, we're certainly going backwards and forwards on tariff debates, and no one really knows exactly where we're going to land on that. Although I have to say, I still think that the playbook's pretty clear for Trump and his team, and it's been written down in a number of places. And the tariffs playbook is simply part of it's transactional, perhaps with more of the allies, and part of it is raising revenues and creating a fair international trading environment. But there's more to it than that. I mean, the reality is Trump's got to create fiscal space to do tax cuts, which means they have to cut on the fiscal side up front, cutting government spending, as we're seeing with Musk's Doge. And in fact, this is already happening. As of day one from Trump's new presidency, the cutting began and the freeze on government hiring began. And in fact, if you look at last year, about 70 or 80% of non-farm payroll job growth in 2024 was either direct government or indirectly related to the government. So, the private sector isn't creating as many jobs as it normally does. The labor market's quite soft. The economy's been driven by fiscal strength under Biden, and that fiscal surge and that fiscal stimulus is going away, at least temporarily. So I think that's the point. Tariffs is clearly a negative, but also that fiscal support is no longer going to be there for the US economy in the first sort of half, 3 quarters of this year. And that I think is where the economy starts to struggle, because under the surface, the housing, the manufacturing, they're all quite weak, and they're manifesting the effects of tight money. And so I think we need more monetary support for this economy in the US in 2025, because we're going to get less fiscal support is really the net. And tariffs, of course, add to the disruption on top of that. So that's kind of how we're seeing it. There are some challenges relative to expectations for US growth, I think, in the near term.
So, Chris, then given that, where is the opportunity?
Well, the opportunity is overseas because, we're in a global rate cutting cycle. Now, I know that, we priced out a lot of the cuts in the States, but the rest of the world is still cutting rates. And I think the US will come back to the party if we get this soft patch in growth. So we're looking for a cyclical upswing later this year. And I think that's what the market is starting to think about as it rotates to Europe. And in fact, it's rotating a little bit to Asia as well. I mean, part of the Asian story is the sort of tech, Chinese tech, deep seek story. But part of it is rate cuts, and particularly in Europe. You look at the banking sector, the banks have done remarkably well. If you look at the southern European economies, they're doing terrifically. Their stock markets, the Italian stock market keeps making new highs. So does the Spanish market this year. So it's not always one-way traffic to the States. At the end of last year, everyone thought it was American exceptionalism and all that. And the Mag 7, of course, they've had a terrific run. But as I said, I think when I came on your show August last year, every man and his dog owned Nvidia back in August last year, and Nvidia's done nothing since then. Neither's Microsoft. So, the world is rotating. The opportunity is in cyclical spaces over the next sort of 6, 12, 18 months. So I think the market's getting the sort of sniff of this, and it's starting to rotate, and we're starting to unwind those extremes in positioning that favored the US at the back end of last year, and everyone disliking Europe, for example, at the back end of last year. That's starting to change.
Yeah, some people have even named their dogs after NVIDIA. Lastly, while we have you here, Mag 7, as you were talking about where we could see opportunity for investors to either take profits right now or just lock into that trade long term, if they were to take profits at this juncture, where do you think some of that money gets reinfused back into the market?
Well, I think mid and small caps in the States can do well. They're going to enjoy the deregulatory environment as it comes about. They're not going to enjoy the initial cuts in government spending, but they're going to enjoy the lower interest rates. I think you're going to start getting a credit cycle in the US later this year. The deregulation agenda, all of that helps small business sector. And along with that, home builders as well. So I think small and mid caps plays on domestic economy outside of the large caps will do well. So we like that. We like the cyclical areas of the market. And I mean, of course, you've got to go over this pullback in the US that we think is coming over the first half of this year. But I would use that pullback to reallocate money to as I say, the small mid caps, the cyclical areas of the market, and maybe even some of the deeper cyclicals as the market sells off. But certainly the sort of classic consumer cyclicals, home builders and so on, I think will do well as we price back in rate cuts into the US curve and as the US large cap market comes off and sets us up for a cyclical recovery in the second half of the year.
Chris, thanks so much for taking the time.